Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at HP Inc., ticker HPQ, formerly known as Hewlett-Packard. They basically did a split with their other part of their business back in 2015, and HPQ here, they're the portion which sells the PCs, the computers, and the printers. So that's what we're going to be looking at today. But before we get into the stock analysis, and make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos. So if you want to get good ideas on potential value stocks to buy or value traps to avoid, make sure to subscribe to my channel, and of course, smash that like button as well. So let's get into the analysis here. First, like to look at some of these overall top level metrics on Guru Focus here. And HP Inc., it's basically stock familiar to a lot of value investors, especially because they have this very low PE typically, and right now it's sitting at 8.89. And we're going to basically look into the financials and see if the stock really is a good deal or if it might be a value trap. So you can see the Guru Focus value band here, which can be good if companies have fairly predictable, basically, financials. It's saying that it's potentially fairly valued. So we're going to see if that's accurate. We can also see they have a pretty good dividend yield of 3.55%. And this is with a very low dividend payout ratio of 0.29%. But this is largely because they spent a lot of money on share buybacks, which we'll get into a little later, the pros and cons and what's actually happening with that and what to expect going forward in the future. So let's dive into the 30-year financials. Since they did a split apart basically in 2015, looking at the 10-year growth rate or 10-year history is basically pretty irrelevant. If you look on the right chart here, the green line, basically since their split they did, the revenue's more or less been flat. The computer industry and printer industry is fairly cyclical. You have little booms where it goes up a little bit, but then the sales can contract as well. And you can see basically over this period of the last just under 10 years, there really hasn't been any growth. And frankly, not even with inflation, which kind of means the business is contracting a little bit. So let's explore that a little bit more. Again, you can see on the income statement here, back in 2015, they had just over $51 billion in revenue. And well, that did have a high of just over 63 billion in 2021. It's contracted back down to 53 billion. So you might have got the illusion that they were a little growing, but in 2020 and 2021, even 2022, but you can see that's contracted right back down. Cyclical industry. The one good thing is the gross margins have been peaking up a little bit. So even though they aren't really growing their revenue, they're still able to maintain those margins. These technically have grown a little bit from 2015 at about 19% to just under 22%, but it's not all it's cut out to be, because you look down into operating margin here, which we're sitting about 8, and this really isn't basically showing any growth from about 2015, 2016, where it was 7.63% and 9.15%. It has been lower, it has been higher, but it doesn't seem to be really growing, because even though they're getting a little bit more on that top line gross margin, because of inflation, things like selling and general admin have been going up at the same time. Basically, if you have your business, it's one size, you're only selling 100 units per year, say, you need an employee to do that, their wages are going to have to go up year after year after year. So that is one of these problems when you get companies that are not growing their revenues. You obviously have potentially other expenses growing as well. So if you aren't seeing growth, that is a potential problem. And that is one warning sign, I'll say, with HPQ here. Another thing is basically their interest expense. As you can see, it has been slowly going up over time. We'll get into this a little bit later, but keep that in the back of your mind. But overall, they're still very profitable. You can see here pre-tax income has been almost fairly consistently above basically $3 billion. Sometimes just ignore these one-off, incomes or expenses. It doesn't give you too clear of a picture. We want to look at the long-term kind of like averages. A lot of these times are not cash expenses either. And as you can see, basically net income, again, as we're seeing, very consistent around that $3 billion range. But even despite the fact that their net income really hasn't been growing at all, it's been fluctuating up and down. The EPS has been growing though, and that's because they've been doing a lot of share buybacks. As you can see here, back in 2015, they had 1.836 outstanding, 1.386 billion outstanding shares, and they've brought it down to just about 1 billion shares. So they've almost bought back half basically their shares outstanding out there, which is pretty significant. But now we're going to tie that in a little bit later to what their interest expense is. Remember to hang on both of those. And as you can see, net margin, relatively over the long term, it's been somewhat consistent. It has been squeaking down a little bit, actually. You could say in 2015, I think this is maybe a little bit high since they have some other net incomes, which we really shouldn't be counting. So let's look at kind of 2016, 5%, 4.8. You have an abnormal 9 because this is from a positive tax provision here. But normally they're around 5, 6%, which has been staying pretty consistent. So again, what we're seeing on the top line is kind of translating to the bottom line for the net margin at least, other than these one-time potential expenses or incomes that kind of throw off the averages. That's one thing you have to keep in mind. Sometimes you get these one-time like tax provisions or one-time expense, which can make the PE, the current PE, look really low or really high. So you kind of have to look more where they are on an average on a normal year without these one-time anomalies. Let's dive into the balance sheet there. So in their balance sheet here, we got total current assets of just under $17 billion. A little bit of cash, receivables, inventories, all that stuff. Fairly capital intensive. You have to have inventories when you're, in the computer and printer business, basically. And they do unfortunately have higher liabilities of basically 23.875 billion. So this is not a good current ratio. If the company wasn't so big and wasn't so established, this would be something basically that could be concerning, but you can actually see the majority of these expenses basically are in pretty much basically accounts payable. So kind of how their businesses work, they don't really worry about too much having all the current assets there because they know they're going to basically sell their inventories, make some money, and be able to pay off their payables and whatever terms and they have with their various suppliers. And you can see over the basically history here, the current assets has been pretty much 20 billion and going below, and total current liabilities has always pretty much been higher than that, although the ratio has expanded probably to the worst current ratio it's been in quite a while. So it is something we should take into consideration that they are using more of their basically current assets than they have in the past, which we'll see basically has been a lot for buybacks. But they do have total current assets of just under $36 billion with goodwill of 8.6 billion. Goodwill basically happens when you do various like mergers and acquisitions. So it's not a real assets. You kind of want to take this out to see what their real tangible assets are they have at the end of the day. And then basically total liabilities is $37 billion. And this is with a lot of basically long-term debt at 9.3 billion. So you can see over the years what they've been doing from 2015, they had $6.6 billion of long-term debt. They actually paid it down for a little bit, down to 4.5, but then they really ramped up their debt. And as we're going to see in the cash flow statement, they've basically been taking out debt to buy back shares. So this does make things look like a lot higher EPS growth in the short term, but when you're taking out debt to buy back shares, you can't sustain that. And it also, in my opinion, does not put you in a very good long-term position if you have any hiccups in your company, because now you have all this debt, and if you start losing money, you have more interest expenses to pay as well. So you can see basically total liabilities, $37 billion, which actually has negative total basically stockholder equity of 1.6 billion. And we also have to remember there was over $8 billion of goodwill. So if you actually look at the company itself, they're about negative $10 billion in the whole, I would say, of equity. And this is one of these things that I feel contributes to the low PE ratio. Since let's just back up here and basically just go to the first sheet and look at the market cap here. They have a $30 billion market cap. And that's what this, 8.89 PE is basically being calculated off of. But they also have negative $10 billion in, basically equity once we factor in the goodwill, which you kind of have to factor that out. If you have the excess cash when you have a high PE, it may kind of mean your PE is a little bit lower, but we kind of have to do the reverse in this and see that actually their PE may, if we adjusted for basically this huge negative equity, would actually be a lot higher than it currently is. And by this ratio, about 30% higher, which puts them into more of a lower teens P ratio once we factor in the equity. But let's pop down to the cash flow statement here. We can basically see, even though they're a little bit more of an older, kind of stable aging company, they actually still do have a little bit of stock-based compensation going, almost $450 million in the last year. Another good thing to look at is the cash flow from depreciation and see how they are replacing that. So we can see basically since 2015, we're getting some overlap from where they were before. So let's look at 2016 going forward and basically compare that to their purchase of plant, property, and equipment. It was fairly stable for the first several years, although they have been dipping below the replacement value. So, at most, they're basically just doing replacement, and at worst, they aren't fully replacing their stuff, meaning parts of their business, maybe because the revenue really isn't growing, are just kind of not being used of old equipment and this and that. But even though that kind of looks nice that they're just at the replacement value, you also do have to factor in that even with this basically flat revenue, they have been doing purchases of businesses. So I don't want to look at 2015 because that had some like overlap with their previous business. But you can see even going forward in 2018, there was $1 billion here, $450 million in 2019, 854 million in 2021, and 2.7 billion in 2022 of basically acquisitions they've made. So this is one problem I see with them is their revenue is not growing. It's basically been staying stable, but they are outputting more money than they basically the replacement value from just looking at cash flow from depreciation and a purchase of plant, property, equipment. Yes, this is at replacement, but this adds significantly up here. As if we look at all of this, this is more, what is this, like three, 4.5, like $5 billion over, so many years there. That's actually quite a bit more averaging per year they're putting into the business basically to just keep revenue stable. So there is some problems with HPQ is that there are elements that obviously are declining inside it, and there are dying businesses, and they're trying to offset that by doing some acquisitions at the same time. So we basically go down a little bit more. You can see that, since these things, they haven't issued any stock, but sure, they bought back. They've bought a lot of stock back. And you can see a lot of these things when their debt was really ramping up. They're buying $6.2 billion of stock in 2021, $4.3 billion in 2022. So they're basically taking out debt, to buy back shares. And you can see here cash flow, from like, the financing at the end of the day. You have issuance of debt, payments of debt. They issued in 2022 almost $4.2 billion of debt, but they only paid down $1.1 billion of debt. So this is one thing I don't like about the company is that they've been taking out this debt to basically buy back shares, maybe not even at favorable prices, which, this doesn't put them in the best position, in my opinion. And they do still have a healthy dividend, though, which they can easily afford, which has crept up to about $1 billion. For companies like this that are kind of, I would say, in the dying phase, I actually much favor companies paying dividends than buybacks. You look at something like Bed Bath and Beyond, and their kind of last decade. I did a previous video on them before, basically kind of showing this. It looked really good. It was kind of your classic value trap. Business wasn't growing, but they spent all their money basically repurchasing stock, which really is just letting management kind of cash out, where they could have just paid out the dividends, and then the people who did hold Bed Bath and Beyond, they wouldn't have basically lost all their capital. They would have instead actually got some dividends back on the way. So this is one thing I would like to see HPQ do, is kind of switch to more paying dividends than basically this insane taking out debt and repurchasing stock. Not my favorite thing to do. So they do have positive free cash flow, though, and generally you can see the free cash flow they have. Very easy to cover the dividends, but not enough to cover their basically repurchase of stock they've done in the past. And you can see now basically the repurchases of stock have slowed down significantly. And with the amount that they've taken, I would not be surprised if these do not reaccelerate basically again, because their interest expense is significantly higher, and you can't basically do this forever. So it kind of looks good for a little bit when you're taking out all this extra debt to repurchase stock, but now they kind of have to slow down. So if you're making about $3 billion in cash flow, maybe a little bit more, you're paying $1 billion in dividend. Well, hypothetically, you could have $2 billion to repurchase stock, but a little bit of that is going to acquire businesses once in a while, which they have to do. So I would kind of project going forward, the repurchase of stock is going to significantly slow down to for sure less than $2 billion a year. If they're doing more and taking more debt, that would be very concerning in my opinion. But let's jump into the interactive chart now and get some idea of potential valuation, considering all these pros and cons. So we only need to look at the last 10 years since that's kind of the only relevant thing. See, going forward in the future here, 15 so I can kind of see a little bit more, but basically revenue is flat. And let's go get the EPS with estimate here. Even EPS is flat too, so maybe this is not fully factoring in their share buybacks, or basically the analysts see that they won't be doing a lot of share buybacks currently. Also, many people know rates are a little bit higher with the Fed, so maybe HPQ is going to be wanting to focus on basically paying down their debt and potentially reissuing it again when it expires at higher interest rates. Also something to basically consider. But next, let's basically look at the PE ratio, see if there's anything that we can tell from that. And you can kind of actually see that there's not a good correlation necessarily with the P ratio. And this kind of gets into the cyclicality when you had 2021 and 2022 when sales for them were more booming and their margins were therefore like a little bit higher. Their PE ratio was really, really, really low, but then the price came down and the P ratio has gone up. So this just kind of shows you that PE is not an end-all be-all of seeing a low PE ratio. You kind of need to see what they're going to be doing in the future and what a realistic average can actually be achieved. Just not what they've currently done in the last year, because it can vary quite a bit. Let's take a look at the price to sales ratio. Price to sales ratio is a little bit better, but again, it kind of has some of those similar flaws where when you have a little bit higher revenue or lower revenue, it can kind of skew things a little bit. But you can see right now, it's like if you looked at these low times when the P ratio is really low, it was a relatively better time to buy the stock. But right now where it is, it's kind of sitting in the mid-range. It could get higher, it could get lower. We don't really know. This is kind of supporting the more fair value argument there. And then also we can look at the dividend yield. The dividend yield's a little bit better, a little bit more at the higher end, not at the highest thing could be, but potentially some people may see some value there. Although with the higher current interest rates there have been, although people expect they're going to come down, you would almost expect you would want a higher yield out of HPQ than it is right now. So even though this is higher to the relatively past, you have to remember back here in these years here, interest rates were a lot lower, and now that the comps are basically higher, you should expect a higher yield from a dividend stock as well. So I wouldn't say just because the dividend yield is high, that means it's cheap. I actually think that what kind of the original Guru Focus value band was showing of it potentially being around fair value is supporting some of what we're seeing here. But let's jump into just stock chart here, a little bit of technicals and see where the momentum is going. You kind of see I got these two different channels going. And basically, kind of since this the split off they did, since here they've kind of been forming this overall uptrend channel here. And you can see actually all during this time here in 2022 and 2021 when they were taking on debt and buying back a bunch of stock, it was relatively high prices actually. So again, this is one of the reasons I'm not always a big fan of share buybacks. I like a little bit mix of it, but I really wish they would actually pay more of a dividend. It'd be a lot smarter for them to do, and it would de-risk the shareholder from potential problems they could have in the future. And as we could see, it's like we're maybe about fair value. We could go up, we could go down. I might consider it when it gets about 25 or under. I'm not the biggest fan of HPQ, but I don't think there's anything seriously wrong with it. I just don't think they're going to be able to be doing any significant basically share buybacks in the next several years. So this could mean a lot of sideways or even a little bit down for them. But if they do get on sale, they are a stock I potentially would like to buy. But anyways, that's my analysis on HPQ. I hope it gave you some insights. Make sure to subscribe to my channel, like the video. If you do want me to look at a stock, leave it in the comments below, as I usually do get to subscriber requests eventually.